The housing market continues to be a major thorn in the sides of way too many Americans, and the average house price is still well over $400,000, which is completely unobtainable for the majority of Americans. But this channel, EconoFin, they might have some good news. Redfin CEO finally admits the biggest housing bubble in U.S. history just imploded. So we'll see what they have to say
The
about
housing
that.
market collapse everyone said would never happen is here, and even industry insiders can no longer deny it. Glenn Kelman, CEO of Redfin, just told CNBC in May 2025 that there's finally evidence of U.S. home price correction, marking the first time a major real estate industry leader has publicly acknowledged what millions of Americans have been experiencing firsthand.
And what's that?
What you're about to hear will fundamentally
Unaffordability.
change how you think about real estate investing and home buying. The data we're sharing
we'll
comes
see.
directly from federal agencies, major financial institutions, and real estate companies themselves. Not speculation.
Nominal versus real house price index. What is this? I'm assuming that's in thousands. I'm assuming 50,000, 100, 150. Am I reading that right? I'm assuming that to be the case, right? Let's see here. Nominal versus real house price index. So, yeah, nominal, absolutely ridiculous. And real housing price index. I mean, that would seem to be a bit more fair if that's actually the case, like across like the US average. I mean, I would say the average house across the US probably should be somewhere around 150, 160,000. If I'm reading that right.
Facts that paint
I don't
a
know.
picture of the most significant housing market correction in modern American history. For years, real estate professionals have maintained that home prices
A lot of
would
people
never
need to
fall
crash.
nationwide. They've dismissed concerns about affordability,
But
blamed
that depends on
everything
unemployment
supply
rate,
shortages, and
most likely.
insisted that real estate always goes up. But Glenn Kelman's recent appearance on CNBC tells a dramatically different story. In May 2024,
Not when housing
he
hits
said housing
400,000.
had hit rock bottom, and by November 2024, he predicted that rents likely to come down in 2025. But the most
But the question is by how much? I mean, I get it. Even if it goes down by 1%, it's still a step in the right direction. But I mean, I'm not so sure I would be really looking forward or expecting rents to drop by like 30% or 25%. I mean, we could all hope and wish that happens, and hopefully it will happen soon because a lot of us are struggling out here, but
damning
we'll see what they
admission
say.
came this year. Kelman said this on CNBC.
We are seeing finally evidence of a real correction where prices are going to come down,
Representing a complete reversal from the industry's previous stance. This isn't just any CEO. This is the head of one of America's largest real estate platforms, a company that processes billions in transactions annually.
Plus, too
Even
many people
more
are buried in
revealing,
debt.
Kelman noted that 22% of active listings have dropped their price, the highest percentage since we began tracking these numbers in 20.
I mean, although that is a good sign that active listings are dropping their prices because, there's just a lack of interest based on the price that they've listed it for. However, 22%, yeah, I mean, that might be the highest percentage since 2012, but it would sure be nice to see that number approaching, let's say, 50 or 60%. I mean, I know obviously that would be good news for a lot of people who are looking to buy a home or just looking to have some relief in how much that they're paying monthly. I don't know. Well, I guess we'll just have to see if that'll keep going up.
Think about that. In over a decade of tracking, we've never seen this level of price cutting.
500,000 more sellers than buyers, estimated of U.S. home buyers and sellers that are actively in the market. So currently in the market, there's 1,453,628 buyers, as opposed to almost 2 million sellers. So, yeah, I mean, that's definitely looking good. I mean, in terms of home pricing, I would assume that might help cause a little bit more of a dent in the housing prices because, I mean, they got to come down like 50% at least, or something like that. I mean, $400,000 is absolutely insane.
This isn't
Absolutely
a minor
ridiculous.
correction. It's a fundamental shift in market dynamics. The numbers don't lie. Let's examine the hard data that reveals the scope of this collapse. In
Well, let's see
Florida,
it. I'm
the
waiting.
situation is particularly dire. Among the 29 major Florida single-family markets tracked by industry analysts, home prices are falling year over year in 19 metro areas. That's 66% of Florida's housing markets in decline. For condominiums,
I like
it's
to hear
even
that. I live
worse.
in Florida.
Prices are falling in 24 of 26 major Florida.
Yeah, the condo price issue is a real conundrum, though. I mean, if you're not familiar with the whole condo market in Florida and you're looking to move to Florida, I would maybe second guess or reconsider getting a condo unless you do a lot of research into the condo that you're buying. Like, just like you have to make sure that the HOA isn't in debt or they don't have outstanding debt. You also have to make sure that most, if not all, or nearly all of their residents are on the up and up with regard to their monthly payments and how much you're looking to pay. I mean, there's a lot of factors that go into that, especially since what was it, the Seaside or Surfside condo collapse that happened a few years ago in Miami. That caused a lot of problems. And now every condo building that's built before, I think, 1980, they have to essentially bring their buildings up to code and they have to have enough money sitting in reserves to afford to upgrade their buildings wherever needed. And it's bankrupting a lot of people. And a lot of people who just don't have the money, they're living in a condo building that was built before that time. And they're getting numbers into the hundreds of thousands of dollars that they have to come up with in a short amount of time just to pay for the building's upkeep. Because these these associations and condo associations, a lot of them are completely mismanaging this money, and they had been for many, many years. And that's causing a lot of problems in the condo industry. So it is no surprise at all to see that condo prices are falling because, look, you might find a condo that's on the market for, let's say, $150,000. It even has like a water view. It sounds just way too good to be true. And it most likely is because the condo that you're looking at, you may have to pay a one-time price of $60,000, $100,000. I've seen over $200,000 that you have to pay to the association for the upkeep of the building, because all these buildings in the state, they're being evaluated for their structural integrity to make sure that they're up to snuff and we don't have another condo collapse situation happen. And a lot of people are finding out that these associations that are managing these condo buildings, they're broke and they're being shady with their reports, or they're not accounting for the money properly, or they don't even have an accounting firm. And a lot of it just reeks of, I don't know, fraud, embezzlement, all kinds of things. I'm not saying that all condos are doing that. Even most of them, I'm sure, are not doing that. I'm sure the vast majority are doing just fine, but there are a lot of condos that are hitting the market that are for what appears to be a steal of a price. And there's a good likelihood that that's one of those things that you're going to have to consider if you buy that condo, the fact that you may have to pay tens of thousands of dollars to the building or the association itself because they're so far upside down on the amount of money that they have in their reserves to pay for this older building's upkeep. And that's just been a big problem for at least a couple of years, I think, at this point.
Representing 92% of the state's condo markets. The median sale price of a home in Florida was $409,900 in April 2025, down 3.2% from a year earlier, with home sales down 8.
Wait a minute. That doesn't look right. April 1st, 410,000. 2025, 415,000. Why is that number lower, but the bar graph is higher? What am I missing there? I don't know.
0.8% from April 2024.
I must not be reading it right.
But these aggregate numbers mask much more severe declines in specific markets. Texas, long considered one of the most stable housing markets, experienced 0% growth in home prices from Q3 2023 to Q3 2024. Inventory increased by 30% in the last year alone, creating a fundamental supply-demand imbalance. According to Wall Street's analysis,
why aren't they reducing their prices?
Of the 33 largest housing markets, major cities are experiencing price declines ranging from 7 to 21% from their peaks. These aren't seasonal adjustments. These are
home price changed from a year ago, but see, they're still above 0%, except for, was that 2023? If it's above 0%, that means that the average home price is still on the increase. Even if it's by just 1%, that means it's still going the wrong direction. At least for us who are looking into someday hoping to get a house at some point in the future, which most of us, it's way too out of reach.
Significant price corrections that represent billions in lost
unless you want to be house poor.
Nationally, home prices rose only 0.65% year over year in April 2025.
They're still rising, though.
18 of the 33 largest and most expensive housing markets, prices are already down year over year. This represents the weakest spring selling season performance in over a decade. The collapse
right.
isn't limited to existing homes.
I guess I'll buy
the
it.
nation's largest home builders are facing their own crisis. Major home builders like Lennar, D.R. Horton, and Pulte Group saw their stock prices drop by 15 to 30% in the past year, even
Yeah.
after the Federal Reserve cut interest rates. This counterintuitive move, stocks falling when borrowing costs decreased, signals deep structural problems in the industry. D.R.
Well, and a lot of these new homes that are being constructed, now they might be just showing the worst of the worst online, but if you go on social media, places like here on YouTube or over on TikTok or what have you, Instagram, there's a lot of people that are either getting their house built or they just bought a new house and it is riddled with tons and tons of problems. I mean, just all kinds of things like the gutters are not lined up properly, or there's a big gap in the windows, or the insulation is really shoddy, or like some 2x4s are split like up in the attic area. Like there's a lot of real issues that are going on with new home construction, and it appears that they're taking a lot of shortcuts, and they're probably hiring people to do these construction jobs that don't really exactly know what they're doing, or they're taking shortcuts themselves. But either way, I think a lot of people would agree out there that new home construction, the quality is far worse than it once was, like probably far worse than it even was maybe even a decade ago.
Horton, America's largest home builder, cut its 2025
Not that new homes
revenue
were all that
forecast
great back
due to
then
weak
either.
demand for homes and missed second quarter profit and revenue estimates in April 2025. The company cited volatile mortgage rates and buyer uncertainty as key factors, with CEO Paul Romanowski acknowledging there's a lot of noise in the market. According to the National Association of Home Builders, 60% of builders are now offering incentives such as mortgage rate buydowns, and 31% of home builders reported lowering base prices by 5% on average.
Yeah, I mean, but I would say if you're looking into buying a new home, never ever waive an inspection. That's for damn sure. And you might just want to research the home inspector that you're looking to get. I mean, if you find an inspector that's charging a bit more than everybody else, and if they explain to you why they do and how meticulous they are and how good they are at what they do, you might want to go with them, at least based on the stories, the horror stories that I've seen, where people move into a new house and all of a sudden just all kinds of problems just start happening where none should be happening. Brand new house, you shouldn't have to worry about anything for years, but people are though, and
When an
they're not.
industry built on
The inspectors aren't
ever-increasing
catching what they should
prices
be.
starts cutting costs this aggressively, it signals panic, not strategy. The current housing crisis stems from a fundamental disconnect between home prices and economic reality.
Absolutely.
According to Redfin, the
100%.
median monthly mortgage payment in May 2025 is $2,860, just modestly below the all-time high, with the average 30
$2,860 is the average mortgage or home buyer housing payments. $2,800 in a month. That's just unrealistic, man. And when you itemize everything that an average person has to pay for on a monthly basis, with just the utilities and insurance and childcare costs, and I mean, you always got to factor in at least a modest amount of entertainment. You know, you want to go out and enjoy, your time off every once in a while. I'm not saying like full blown vacations or anything, but I mean, you still got like your phone that you got to pay for. Plus, people have the annual holidays to worry about. And I mean, the list just keeps going on and on. Subscription services, I mean, there's more of those than ever. I mean, people with Netflix, and like if you deal with Adobe, now you gotta pay annually for Adobe. I mean, freaking Adobe, for crying out loud. You can't even buy it on a disc anymore. You have to freaking subscribe to that shit now. And it just, the list keeps going on and on. I mean, I've heard of some people, they're paying hundreds and hundreds of dollars a month just on subscription services, which is absolutely crazy, man.
year fixed mortgage rate at 7%, only around 31.5 million households
Plus
can
inflation,
afford a median
plus
priced
the cost
home
of food.
at $459,826, requiring a household income of $147,433.
What? All right, let me read that again. With the average 30-year fixed mortgage rate at 7%, only around 31.5 million households can afford a median-priced home, which is at $459,000, which requires a household income of $147,000. I hope that the next slide, or the next bullet point, shows how much the average American household is earning, because I know it's nowhere near that. So, I mean, how is that possible? I mean, I guess that's really what they're getting down to. The biggest housing bubble, it's It's happening. It's about to burst. And this has been the case here in Florida for a long time. Here in Tampa, at least, like the average household income here is somewhere around like $70,000 a year, but the average salary that you have to make to qualify for the average priced house here is $106,000 a year. I mean, if that's not a bubble, I don't know what is. Maybe I'm not knowing what the definition of a housing bubble is, but I believe that's what it is when, people just can't afford it. They cost way more than people can afford them. And that's been the case for a while, at least for the last few years.
The median price of an existing home in March 2025 was $403,700, the highest March median the National Association of Realtors has ever recorded.
So that means it's not going down.
March 2020, the median sale price was just $280,700.
That's absolutely crazy, man.
That's a 44% increase in just 5 years.
Absurd.
While median household incomes increased by nowhere near that amount. 58% of
But my question is how do people keep buying them though? If nobody bought these houses, you would think they would naturally reduce in their prices, because people, if they have to sell their house, I mean, it's not just going to sit on the market forever. If nobody has any interest in the house for months on end, I mean, it's just common sense that your house is probably too highly priced, unless you've got some other hidden issues that, the public doesn't seem to be aware about.
Single-family loans carry rates below 4% as of September 2024, compared to only 14% above 6%.
That's a problem. A lot of people don't want to move for that reason.
Homeowners are trapped
because they're locked in a good
homes,
interest rate,
afraid to sell and take on new mortgages at much higher rates. The result is artificial scarcity that has temporarily propped up prices, but this dynamic is now breaking down.
Really?
Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting.
I'm curious to know why.
Each like and subscribe helps support this channel and keeps us motivated to keep...
I mean, like a buddy of mine, he bought his house in 2021, I think it was, and he got a crazy good interest rate. I'll have to ask him again, but I believe it's below 4%. And dude, here he said, he's like, look, I might have paid a little more for it than I probably should have at the time, but the interest rate that we're locked in at right now compared to around 7% today, he said, I don't think I'm ever going to move ever again, because I think he's right. The interest rates, I don't think they're going to come down anytime soon. If anything, they might end up having to go up, but I really don't know.
Great content. Thank you. Now,
kind of mind-blowing.
Continue. During the 2000s housing bubble, 7 metropolitan areas, Tampa, Miami, San Diego, Los Angeles, Vegas, Phoenix, and Washington, D.C., appreciated by more than 80%. However, the current bubble dwarfs that period in both scope and magnitude. In some markets, prices have increased by over 300% since 2000, with particularly dramatic spikes occurring during the pandemic period from April 2020 to July 2022, when some markets saw 62% increases in just 26 months.
I mean, look, let me go back just a tad. I mean, look at this. Back in 2012, the median home sales price in the U.S., it was only about $150,000. I mean, like, what is that, like 3-4 times higher now? 150, 300, 300, 450. Yeah, it's like 3 times higher. Since 2012, that wasn't really all that long ago. It really wasn't. I mean, it was a while ago, but it wasn't that long ago. And it's just still below 300,000 by 2020, but just... yeah, I mean, it's just nonsensical,
when some markets saw 62% increases in just 26 months. The median sales price for existing homes increased 50% between 2019 and 2024, from $271,900 to $407,600.
And what is it, supply and demand or what?
This rate of appreciation is historically unprecedented outside of
What's the reason for the sudden spike low?
Represents the largest housing bubble in American history.
I mean, is it because the government printed too much money? Or is it because there was an extremely high demand for housing? I know there was in Florida back during COVID in 2020 and 2021. And that's what drove up the cost of houses in a big way here, because there was a really low inventory for houses for a period of time. And a lot of people were looking to move here. So it jacked up the cost to get a house. But I mean, other than that, I don't really seem to understand exactly why they shot up so fast nationally. I mean, I'm just kind of at a loss for words
Multiple
when it
measures.
comes to that. I'm not
Approximately
really sure.
30% of construction workers are immigrants, and potential immigration policy changes could cut labor supply in the construction industry, potentially exacerbating housing supply issues. Meanwhile, tariffs on construction
Well, dude, that would
materials
drive
could lead
up
to
the cost
higher
of
building
housing.
costs, further complicating the market dynamics. Existing home sales are projected to reach 4.25 million in 2025, which represents a
But there is one thing I do know is that we're supposedly in a overall housing shortage, meaning that after 2008 happened with the housing crash, new home construction plummeted very sharply, and it hasn't really recovered since, at least not in that big of a way. So we have like 3 or 4 million undersupply of homes across America, which is also driving the cost of them up. Plus, we get all the immigration that's been happening, which is probably also going to drive them up because, I mean, everybody's got to live somewhere. So that's probably also exacerbating the problem.
3.3%.
So, I mean, yeah, just because with new home construction, if a lot of immigrants are sent back home, I mean, if they get sent back home, then that means wherever they're living right now, that's going to become available for somebody who does live here. So if you send however many that there might be, 10 million, 20 million, 30 million, if you send them out, then you're going to get a lot of vacancies, which I would assume would not only drive up the inventory, but it should also drive down the cost overall too, because, you know, where there's a high inventory and everybody's trying to sell a house and there's houses all around them that are also for sale, usually what gets them to sell their house quickly is by simply lowering the price. At least that's what
decline
common sense
below
is telling me.
2019 levels, keeping sales near 30-year lows. This dramatic reduction in transaction volume indicates a market that is essentially frozen up due to affordability constraints. CoreLogic identifies 3 Florida markets with a very high risk, over 70% probability of price
God.
decline:
I
Tampa,
hope
West
so.
Palm Beach, and Winter Haven. Florida's
I
housing
really
inventory
hope
has
so.
surpassed pre-pandemic levels, driven by a wave of completed new construction and existing homes hitting the market, while buyer demand has cooled. Texas markets now have about 4.8 months of home inventory, and homes are staying on the market for an average of 56 days. This represents a fundamental shift from the rapid sales that characterized the market
They're still
during the
selling kind
pandemic
of quickly,
boom.
though. I mean, that's
In
only
18
2
of the
months.
33 largest and most expensive housing
I know it's a
markets,
while, but
tracked by major indices, prices are already down year over year. This isn't a regional phenomenon. It's a national correction that's spreading across multiple metropolitan areas simultaneously. The data suggests that waiting
look,
may be
man,
the prudent
a correction is not going to be the price for housing to drop by 5% nationally or 10%. I mean, a correction would be housing overall going from, what was it, like $450,000 down to, let's say, about $300,000. That would be a correction, at least in my opinion. If it drops by like 20,000, I'm sure that channels and certain people who are in the real estate market, they'll be singing those praises that, you know, it's in a rapid correction, or it's even signaling a crash or whatever. But I mean, if housing drops by like 30%, 40%, I mean, everybody's going to be screaming housing crash, but it's not. It's just going to correct back to where it was in like 2019. But one problem that happened, especially like around in 2008, was the unemployment rate skyrocketed. And when unemployment goes up, so does foreclosures. And that's what I've heard somewhere else. But see, we're not in that kind of environment right now. Like our unemployment numbers are still relatively low, actually very low. And a lot of that's probably because of the immigration issue, because there's been tens of millions of people that have flooded into the country. And most of them, they're going to look for work somewhere. They're going to find work somewhere. A lot of them won't, but most of them, I'm assuming, will. So that's going to keep unemployment numbers way down, which is also going to cause, you know, a more prolonged problem with the housing market, because people are going to keep paying their bills if they're still employed. So that's just an issue that I see pushing back a bit against, you know, what they're saying as far as this goes. But I get what they're saying. Like we do appear in 2025 to be heading generally in the right direction with regard to home prices being
choice
reduced
for many
overall.
prospective home buyers. Mortgage rates are expected to remain between 6.5% and 7% throughout 2025, while price corrections continue to unfold across major markets.
Frankly, that's not high enough. I think it should be like 12, 13%. I think it should be way higher than it is right now. In fact, I think it should have been that high going all the way back to like 2020, because that's going to drive down the demand for housing in a big way, which I would assume if housing goes down in a big way, then the prices are going to go down, because you're going to get a lot of people trying to sell their houses, which I know like there's not a ton of people trying to sell houses today because they're locked in a good mortgage rate. And if you sell your house, you're going to have to move somewhere and you're going to get locked into a much higher mortgage rate. But I think that would be a big factor in the value of housing going down, just in my opinion. I mean, I'm no like economy expert or anything, but I must have heard that somewhere.
Fannie Mae economists expect that nominal wage growth will outpace home price growth for the first time in more than a decade in 2025, indicating that affordability may
Really?
slowly improve even without dramatic price declines.
Well, that's
if you own
inflation,
property
baby.
in affected markets, the priority should be preserving value rather than expecting continued appreciation. With 36% of listings accepting offers within 2 weeks, down from 41% the year prior, sellers need to be realistic about pricing and timing.
Yes, they
The
do.
institutional investment thesis that drove much of the recent price appreciation is breaking down.
And if they're employed, then they can sit in their house for longer, theoretically. But if unemployment were to soar like it did in 08 and 09, then people are going to be in a frenzy to sell their houses. They're going to try to undercut everybody else in the neighborhood if they recently lost their job, because they don't want to fall into foreclosure territory and end up losing their house. So you're going to get a wave of people that are going to be desperately trying to unload their house, and they're going to drop their prices faster and faster, which, if I can remember that, or if I do remember right, that was a contributing factor in the cost of housing going down so quickly back then, just because of the amount of unemployment that went up. But that's not something I want to see either. I don't want to see unemployment go up, because that's not good for anybody. I mean, that's bad for everyone across the board for the most part.
Rising interest rates have significantly increased the cost of capital for investors, making it difficult to earn cash flow and reducing the attractiveness of real estate investments. JP Morgan Research expects house prices to rise by only 3% overall in 2025.
Well, that is not the biggest housing imploding. That doesn't signal, in my opinion, that this big housing bubble that we're stuck in is in the process of crashing, if that's actually true. Oh, they're only rising by 3%, but dude, that's in the wrong direction. That means housing is still going up and up and up and up. It has to go down. It's got to go down.
Mortgage rates expected to ease only slightly to
And mortgage rates
6.7% by year
lowering
end.
are not going to help
these
things.
national averages mask significant regional variations, with many markets expected to experience continued declines. Freddie Mac expects the pace of house price appreciation to moderate from the levels seen in 2024, while still maintaining a positive trajectory nationally, but acknowledges that regional differences will be significant. Unlike previous housing corrections, this one may be prolonged due to the structural affordability crisis. Fannie Mae's economists shared predictions that existing home sales will remain near 30-year lows throughout 2025, suggesting that market normalization could take years rather than months.
Jeez,
Glenn
man.
Kelman's admission represents more than just one CEO's opinion. It's an acknowledgement of a new reality that the real estate industry can no longer ignore. The combination of unprecedented price appreciation, affordability constraints, rising interest rates, and changing demographic patterns has created the conditions for the most significant housing market correction in modern American history. The data is clear. Home prices are falling across major markets. Sales volumes are at multi-decade lows. And even the largest home builders are cutting forecasts and lowering prices. It's not just a temporary pause
By
or
how
a
much?
seasonal adjustment. It's a fundamental repricing
JP Morgan
of
said
American
housing's going
real
up.
estate. For home buyers and investors, the message is equally clear. The old rules no longer apply. The assumption that real estate always appreciates has been shattered, and success in this new environment will require adapting to a fundamentally different market reality. The biggest housing bubble
Well,
in
it
U.S. history
appreciated
isn't just
unrealistically
imploding.
over the last few
According
years,
to the
though.
CEO of one of America's largest real estate companies, it has already begun. The question isn't whether this correction will continue, but how far it will go and how long it will take for markets to find a sustainable equilibrium between prices and economic fundamentals. The housing market that emerges
we'll
from this
see.
correction will look very different from the one we've known. For millions of Americans, that change can't come soon enough. If you found this video interesting,
Yep,
please
I agree. It really can't come soon enough. I mean, it's not really sure. Not really sure what to make of that exactly, but, I mean, I think things are going to change as far as housing prices having to come down at some point, because young adults, Generation Z, eventually Generation Alpha, they certainly won't be able to come close to affording housing at this price as they get older, as the years go on. They're just not going to. I mean, they're in their 20s. I mean, they're making like what, probably 40,000 a year, maybe 50,000 a year. They're not making like $140,000 a year. And plus, we're below replacement rate too. I mean, our population is in decline. At least natural born citizen population is in decline, which is not just here, it's across the West. But, when the population keeps declining, that's also going to probably factor into this whole issue as well. But I do have a little bit of information here that I'll run down just briefly here. So will the housing bubble burst in 2025? Apparently it's not as easy as it sounds. Predicting whether a housing bubble will burst in 2025 is complex, as it depends on multiple economic, social, and policy-driven factors. Based on the available data and expert analysis, here's a clear and concise assessment. Why a housing bubble burst in 2025 is unlikely. The tight housing supply, despite increases in inventory, which is up 17% from 2024 to 2025, the U.S. still faces a chronic shortage of homes, estimated at 4.5 million by Zillow. Low supply continues to support home prices, reducing the likelihood of a sharp decline. And apparently, we just haven't been building new construction homes at the rate that we were previous to 2008, maybe even years and years previous to 2008. Ever since that happened, there's been a big slowdown in new housing that's been getting constructed around the country. So that's apparently factoring into this whole chronic shortage of homes. So they're just not building them fast enough. But again, like I said, I know this is going to take years and years, but our replacement numbers are down, which means our population is going to be in decline unless we import more and more immigrants, which of course the United States, I mean, that's what we've always done. We've always imported immigrants. So, that's not really probably going to be a major problem for us specifically, not like it will in places like Japan and South Korea, where they're going through rapid population decline, or they're not hitting their replacement rate numbers. They're not even close. So, I mean, that might play a factor into it, but I don't know. I guess we'll just have to see as time goes on. So the next point is strong homeowner equity. Over 46% of mortgaged homes in Q1 of 2025 were equity rich, meaning the mortgage balance is at or below 50% of the home's value. This high equity cushions homeowners against price drops and reduces foreclosure risks, unlike the 2008 crisis. However, I have read somewhere that home equity loans have gone up sharply, and you also have to factor in the amount of debt that people have too. The credit card debt that's out of control, student debt that's out of control, the car debt, even that is out of control. And people are struggling to find ways to keep up with their lifestyle. And COVID really made that into a big problem when it comes to individuals' spending lifestyle. A lot of quote unquote doom spending was happening back then, where people were just gobbling up all kinds of stuff, just buying stuff on Amazon, online shopping. People were even swiping their credit cards to go on vacations. And now there's a lot of people in debt, including a lot of people who have these houses that are equity rich. So you might see in the coming years a situation where a lot of people who may be equity rich, they may be forced to sell their house just to satisfy the insane amount of debt that they've accumulated over the years. So, I mean, that's could potentially be good news from an overall perspective with regard to housing potentially coming down. But anyway, the stricter lending standards is another point. Post-2008 regulations have tightened mortgage lending, reducing the risk of widespread defaults that fueled the last crash. Experts note that homeowners are in a stronger financial position today. And also, again, the issue with unemployment numbers are pretty far down. Of course, it does depend on the field that you work in. I mean, I don't know if getting into big tech would be the best time, to go into that field, but there are certain areas of the job market where they're doing mass layoffs, but there's also areas where they're not really doing so much of that. But that's another thing that I've seen on social media. There's a lot of people, especially younger Americans, they're talking about how The housing market is just absolutely crazy right now. It's impossible, or not housing, the job market. It's impossible to find a job. I've been looking for a job for months and months and months. I've applied to hundreds and hundreds of places, and I cannot find a job to save my life. And I don't know why they keep saying that the job market and the unemployment numbers are so low, because I can't find a job to save my life, and it's driving me nuts. I had to move back in with my parents, and on and on and on. In my opinion, I think the reason is probably because of the immigration, the massive influx of illegal immigration. Because, like I said before, a lot of, if not most of them, they're going to find a way to make money one way or another. And that's going to most likely keep the unemployment rate low, even though I'm sure a lot of those jobs go unreported. So, I mean, I guess you could factor that in also. But anyway, that goes into this next point, the economic stability. Unemployment remains low at 4.2% as of May 2025, and no significant job losses are forecasted. Even though I do keep seeing, companies like Microsoft, and I think Amazon was another one. I think Tesla might have been another one. Like there are a bunch of companies out there that are laying people off at a fairly consistent rate. It just must not be across the board like it probably was back in the late 2000s. A stable economy supports housing demand, making a crash less likely unless unemployment spikes unexpectedly. Which, I mean, I could circle back to the whole debt situation. If people are maxed out on their debt and they can't swipe their credit cards anymore and they have to satisfy their debts, that means that their spending power is going to just drop to almost nothing, really. And when a lot of people's spending power goes away and they can't spend money like they were because they have no more debt to max out, or no more credit to max out rather, then that could fuel an unexpected unemployment crisis because people don't spend money. There's a lot of companies out there that heavily depend on that, especially the service industry and the retail industry. I mean, that could trigger a significant problem in the short term, but I don't know. We'll just have to see, I guess. And let's see here. So factors that could increase the risk of a downturn would include high mortgage rates. As of June 2025, 30-year fixed mortgage rates are around 6.81%, with projections suggesting that they may stabilize near 6.5 to 6.7% by the end of the year. If rates rise significantly or fail to drop, affordability could worsen, dampening demand. And then there's regional vulnerabilities. Markets like Florida, Austin, and Phoenix, which saw significant price surges during the pandemic, are experiencing corrections, with price declines in some areas, such as Austin being down 23.4% from its 2022 peak, even though I'm sure housing is still crazy expensive there nonetheless. These localized corrections could spread if demand weakens further. Then there's economic policy uncertainties. Potential policies under the Trump administration, such as tariffs or mass deportations, could raise construction costs and exacerbate labor shortages, potentially increasing home prices or stalling new construction. So what are you saying, Grok? Are you saying that it's the illegal immigrants that are building all of our houses right now? But even still, I mean, new home construction, according to up there at the top, Grok was saying is significantly down compared to about a decade and a half ago. So, I mean, I don't know whether to make heads or tails of that one. So, rising foreclosures. Some ex posts highlight concerns about increasing foreclosures and housing defaults, though data from ATTOM shows only a 9% year over year increase in March 2025, not yet at crisis levels. I mean, 9%, it's a pretty hefty increase of foreclosures and housing defaults. But, I mean, we'll see. There are a lot of people who did buy a house in 2022, 23, probably even last year, and they realized they got in way over their heads. The people who consider themselves house poor, who have deep regrets about buying this house because now they've got a mortgage that's like $2,800 a month, and they realize, wow, I can't really afford to do really anything else. I'm just stuck at home all the time because all my money's getting sucked up by my mortgage and my homeowner's insurance and property taxes, plus maintenance of homes. I mean, a lot of people probably don't factor that in either, that you have to put away, I think it's like roughly like what, 2, maybe 3% of your entire house, the entire value of your house, or however much that you paid for it. You have to be stuffing that away. You got to squirrel it away on an annual basis, just in case any kind of like home crisis were to arise, or maintenance or what have you. Like, you're going to need a new roof eventually, or maybe a pipe might burst, or, God knows what could end up happening. You could, like go up in your attic and realize there's like a mold outbreak or something. I mean, there's a million different things that could go wrong with a house. And I'm sure there's not a lot of people, probably especially younger Americans, because, a lot of them don't really seem to have the level of common sense that their parents and grandparents had. But I mean, they're probably not putting away an adequate amount of money in the event that something does go wrong with their house that will require an immediate fix, or even something like an appliance like a refrigerator or whatever. I'm sure the majority of people in that situation are just swiping their credit card, and they're just going to have to pay 20-30% interest on that purchase, which is only making the debt situation even worse. So, but also there's the stale inventory. Redfin reports that 54.5% of homes in November 2024 sat unsold for over 60 days, indicating weaker demand in some markets. If this trend worsens, it could lead to price softening. So, while the establishment narrative leans heavily on the idea that a crash is unlikely due to supply constraints and homeowner equity, it's worth questioning whether this optimism overlooks underlying risks. The 2008 crash was preceded by a widespread denial of a bubble and current affordability challenges. Let's see, the housing affordability index near historic lows could signal stress if economic conditions deteriorate. Additionally, speculative posts on X about a looming collapse or 30% price drops lack robust evidence but reflect public anxiety, which could influence market sentiment if panic selling does emerge. So, in conclusion, most experts agree that a housing bubble burst in 2025 is not likely due to limited supply, strong homeowner equity, and stricter lending practices. However, risks like high mortgage rates, regional price corrections, and policy driven inflation could lead to a localized downturn or a broader market slowdown. For potential buyers or sellers, decisions should prioritize personal financial readiness over attempts to time the market, as predicting exact outcomes remains challenging. So, yeah, let's see here. So, if you're considering buying or selling, focus on your financial stability, your debt free status, 3 to 6 months of emergency savings, and a down payment of 5 to 20%. Yeah, I mean, good luck getting almost anybody to have all of that lined up today. I mean, what the average house in America, what did they say that it was in that last video? I think it was like $450,000. But even if I just took $400,000, I mean, I'm sure the math is pretty easy, but it's kind of late, so I'm not thinking too good right now. Times point. So $80,000. I mean, that's on the higher end of the down payment, but I mean, that's probably what your lender and probably what every financial advisor would recommend, saving up 20% to put down on your house. That way you can lower your monthly mortgage. But that's $80,000 that you have to save up for that, which for most of us will take years to do. Plus your 3 to 6 months worth of emergency savings, which for many people that could go into the tens of thousands of dollars. So we're up over $100,000 at this point. And plus you also have to factor in not just your emergency savings, but the event that if something happens to your house, like if your water heater breaks while you're at work and your house gets flooded out or something. I mean, like it could be a myriad of different things that could happen. So you got to put money aside for just your home's maintenance as well. So, I mean, yeah, all of these different factors, I mean, it just makes it just that much more challenging to be able to successfully purchase a house and stay in it for a long period of time today, especially. So let's see, rather than waiting for a dramatic market shift for specific, well, let's see, provide more detail. Okay, yeah, so that's basically the gist of it, and that's really more or less all I have. Yeah, there is a lot of anxiety in the housing market, and there's a lot of people that are expressing their worries about the housing market as opposed to people celebrating the housing market. Although there are a lot of homeowners out there, I believe it said greater than 50% of people out there, they own their home, or they're at least mortgaging their home. They're on the pathway to owning their home. And yeah, the value of housing skyrocketed over the last few years, which means that their equity that they have in their home has also skyrocketed. I mean, if you just bought a house in like 2019 and you bought it for $300,000, there's a pretty good chance that house might be worth like, $500,000 today, or $550,000, which means you got a lot of equity in that home, even though you still owe, the better part of 30 years left on your mortgage, 20 something years that you still have left to pay for it. But yeah, I don't know, man. I don't know if things are going to get better. I really hope they do. I mean, if the prices go down even by 1% from this year to the next, it's still a step in the right direction. It's not nearly quick enough But if things remain high for the foreseeable future, I mean, what will trigger it? Because I truly think, I believe that if houses do stay elevated at this rate for years and years to come, something is going to break it. Because I mean, at the end of the day, younger Americans, they're not making the amount of money that older Americans are making, and they're getting stuck with having to pursue a house that costs 2, 3, 4 times as much as their parents paid for their house. And wages they're going up, but they're not going up really at the rate that they should be at all. So there's got to be a breaking point somewhere. I mean, there's too many variables, there's too many factors at play that would suggest that, housing would just continue to go up in cost and value, and we're just gonna have to live in the new normal and just deal with it. I'm really not sure what to make of it, but hopefully things will start coming down soon. But in the meantime, that's all I got. So thanks for watching, and see you later.